This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome to another episode of Not Fintech Investment Advice, your favorite podcast where we don't give any advice of any kind, certainly not investment advice or anything that you should take too seriously. I am joined by a very serious person, someone who creates a tremendous amount of content. I can barely pin him down to record the podcast. He's here, he's there, he's everywhere. The author of Fintech Brain Food, as always, Simon Taylor. Simon, hello.
Can you just follow me around and intro me everywhere? Because I need that when my toddler walks in and goes, "Daddy, I don't like you anymore," and it's just like that's. I just need Alex coming in as my hype man, being like, "Okay, yeah, that was all because I said no to dessert, but that's fine. That's fine. It is what it is."
Yes. No, yes, I can. I would be happy to do that. I don't even need to be paid, Simon. I'll just follow you around and introduce you as you walk into rooms. And B, I could not more resonate with the toddler problem that you have, which is that you either get a lot of love and adoration, but let's be honest, you're probably making bad parenting decisions that your wife is looking at you going you said yes to what? Or you're the bad guy and they hate you. And that means you're doing probably good parenting things, but it hurts your soul. There's no winning, man. There's no how about we do this responsible thing that you don't really want to do, but you also love me and think I'm the best ever. Is that possible?
Yeah. Welcome to Not Parenting Advice. It's not quite fintech. It's the spin-out show that everybody deserves.
Can I tell you something? I am going to do that with you at some point. It's not today. I promise we will get into not fintech investment advice, but I don't know. We'll need to figure it out. Maybe Father's Day next year. We do
maybe that's the Christmas special.
Yeah, I love it. We'll have to do, not parenting advice because you and I have, I'm sure, some really not useful at all parenting advice, given that I know nothing about parenting.
I mean, I'm the king of not useful.
Yes, again, something that our spouses would probably co-sign on. All right. So, Mr. Taylor, as always, we are going to walk through a couple fintech companies that we think are interesting. Would you care to go first?
Sure. Let me roll out with fintech number one. And this one is called Niva, Niva, or Niva.
Yes. I think Niva in my brain, but let's just say
it feels like a Niva. Anyway, name aside, they help lenders and fintech companies and banks onboard business customers through a KYB or Know Your Business process. So mid-desk for everywhere else. Right? Because Middesk in the US is now fairly well known. There's also, I think, Base Layer that's a competitor, and there's a few folks in that category. There's Detected in the UK. There's a few others across Europe. Niva's wedge markets are actually Latin America. So it's focused on sort of Brazil and Mexico in particular, but also a number of those markets. So they would do everything you would expect, like collecting documents, checking them against government databases, and screening for any sanctions risks, as well as bringing in lots of different data sources. And they aim to bring onboarding for business customers down to about 10 minutes. And they'll even check taxpayer status, screen for active litigations. So listen, I think there's a massive need for this outside of the US. In the US, it's kind of become a default and it's rolling out everywhere else. But in a lot of ways, the US is a leader in KYB in a way that I don't think it gives itself credit for. It likes to think of itself as a little backward in finance because it's terrible at payments in real time. But that aside, there's really quite some way ahead on that. Once you leave the US, it's a zoo of local providers or a vacuum. Whereas actually, if you look at some of the LATAM markets, especially outside of Mexico and Brazil, there is a giant emerging opportunity, whether it's Peru, whether it's Colombia, there are Chile. There are markets with 30 to 50, 60 million populations and emerging fintech ecosystems that need this type of capability. And if you are building for that, the SMB space will no doubt be hot. We've talked a lot about the CFO stack. So what are your thoughts?
Well, I'm glad you mentioned this one because I did just write about them in the newsletter a little bit in the context of KYB is hot, man. It is hot, hot. It is like burning my hands hot. KYB might be too early to say this, probably is, but is it coming for the crown of like the most sort of hot, crowded fintech category? Has it displaced expense management and spend management, Simon, one of our favorite categories? I mean, I don't know, probably not quite yet, but it's getting there. There are a lot of these providers. Now, to your point, the US is definitely like the center point, I think, for a lot of that. We have a ton of KYB providers, both sort of legacy providers and now just a whole raft of new ones. I did notice with Niva that their focus is on kind of global or international, which I do think is an interesting differentiator. It kind of reminds me a little bit actually of, how suddenly the payroll space got really crowded, right? Where like suddenly there were just tons of new companies doing payroll and all the sort of adjacent kind of HR and ERP type functions around payroll. And then within that sort of universe of payroll, there was a subsector of companies that said, we are going to specifically focus on global payroll because we think that in a more interconnected work from home sort of digital world, there's actually going to be a lot more companies, including small companies and startups, that are going to have a global workforce. And so you might work for a company that has 25 people, but they're based in 6 different countries. And you're going to need a payroll system that's optimized from the ground up to handle global payroll and navigate all of the rules across different countries for doing that. I think there's a similar opportunity, not just in payroll, but everywhere, which is kind of global by default for all of this infrastructure. Because to your point, there are emerging small business ecosystems, digital ecosystems, fintech ecosystems in Brazil and Peru and in Mexico and all over the place. And so I could definitely see you being in a position if you're whatever provider, and you're trying to work with businesses across the globe, it being frustrating to sit down and go, okay, we need to do KYB. What are our options? And either you have a great option for just the US or just the UK or wherever, or you have these horrible legacy providers that you don't want to work with, but they're the only ones who've kind of slowly over time scaled to have global coverage, or at least partial coverage globally. So I do think kind of global by default is a trend I'm seeing across a lot of different places because we're all starting to recognize the infrastructure implications of the world changing and having really, especially since COVID, just being like a different environment. Does that make sense?
It completely does. I work for a remote first company. It's one of the investors is famous for saying every company will be a fintech company, but they're also famous for saying default global. And actually, what you're describing is something that I've heard Angela say several times, default global, which has driven a lot of the activity. You typically see it's actually default regional. People are strong regionally. But then you look at like a remote.com or a deal, and they truly have gone global. They start with a wedge area. For those guys, it was people in the United States that have employees in Latin America, but now it is kind of everywhere as they've expanded. And that's driven tremendous revenue growth for those businesses. In fact, I would argue they've been much more successful than some of the US-based payroll company startups because they truly did address a much bigger unmet need. And perhaps that's true for global KYB as well. Like, how big is this pain point for lots of different companies? And what do we unlock once we have this category? So, yeah, I'm with you. I think global KYB is becoming hot because the need is real, but also because you've got some early proof points starting to gain traction. With all these things, though, there's a difference between KYC and orchestration. There's a difference between what Socure does and what Alloy does. There's a difference between KYB and KYB orchestration. There's a lot of things that call themselves KYB, but are actually just putting together lots of other solutions. If you can actually identify the business and its ultimate beneficial owners, its UBOs, any sanctions risk that the UBOs have, and then you can go deep in pulling the raw data sources from government databases yourself, then you have some core intellectual property that is extremely valuable. If you can then deal with a lot of the workflow that comes off the back of it, then you're in a really great space because the workflow is hard and you could orchestrate it, but actually you sort of end up in that 10 to 25 million valley of death in terms of revenue if that's all you ever do. However,
Right.
if you go further and you are able to bring in some underlying intellectual property, that can become a huge unlock. So yeah, maybe it is the next big thing. You heard it here. That sounded awesomely, awkwardly like fintech advice. Maybe is this the next big thing?
I mean, for those who invest in Niva, give your thanks or your curses to Simon, because he's the one who gave that advice, not me. But no, I totally agree with you. I think the deep versus wide is such an interesting problem with this, because I think everybody always wants to get to orchestration, because orchestration is sticky if you can get in there. But I've always sort of thought you have to earn your way to orchestration status over time. You can't just immediately skip to orchestration and be like, we deserve to be the ones who orchestrate these workflows, right? Like, that's not how that status is attained inside of these companies. And so I agree. I think there is an element of going deep. And maybe the reality is that you're better able to build that intellectual property and go deep if you go into countries where KYB is less mature, right? So like in the US, are you really going to outcompete all the other KYB providers for building that IP and that sort of differentiated mode around your product? It's going to be tough. Everybody knows how to go to the state secretary and get the updated business information. Like, everyone knows how to do that. But probably a lot of providers don't know how to do that in Peru, or haven't done that in Peru. And so I do think there is a way to expand and build that depth globally. So anyway, I'll be very curious to watch. Again, maybe one to watch. Simon, can I give you my first company?
Please do. Please do.
Okay, well, let's stay on the general category of B2B, and I will present to you OatFi, which is a company that has a very fun name, I will say off the top. And what they do is essentially embeddable lending as a service for working capital loans. So the idea is, if you are a platform that works with businesses, you could be expense management, you could be bill pay, you could be any number of B2B platforms out there, particularly B2B platforms that touch payment flows in some way. It is a very natural extension to go off of the payments that you are processing for your business customers and lend them money, because payment flows, it turns out, are a really good way to determine how and when and if you want to underwrite a business for credit. And because you're seeing their cash flow, you're seeing their ability to pay, and you're also seeing like the ebbs and flows of their business. And you might be able to get early indicators from that real-time payments data as to, hey, this business looks like things are slowing down. They might need a working capital loan. And even before they go out and start shopping for one, we can just offer it to them. And then, oh, by the way, because we're the platform that they process payments through, we can just collect payments for that loan directly out of the payments that we process for them. So we've seen this dynamic sort of take hold in a lot of the existing commerce enablement platforms out there. So your Squares and Stripes and Shopify's, they all do a version of this, right? Where they're processing payments. And so why not add capital as another thing to it? But if you are not Shopify sized and you don't have the type of resources that they have, you might not be able to build your own lending product yourself. Hence the existence of OatFi. And what they do is essentially they provide an API that you plug into that can pass the payment information you have on your businesses to them. And then they will underwrite those businesses for working capital loans. And if the businesses take the loans, they will do all of the servicing, they handle all of the compliance, they handle all of the collections. It's literally lending as a service end to end that you just switch on. And the benefit to the platform is you are able to offer lending, so you're a little stickier, and you are able to add a new source of revenue for your business and diversify your revenue model beyond just SaaS subscription fees and payments, and start to continue to kind of build out that diversified business model. And the most interesting thing to me, Simon, is that because OatFi is doing all of the work to do compliance, to do underwriting, servicing, collections, the whole thing end to end, they own all the credit risk. And so they're splitting the revenue with you, but as the platform that is offering this to your business customers, this is a risk-free source of revenue that you can turn on within your platform. So this is, I think, a trend. I've seen a few other providers do this, but what's your take on embeddable lending as a service for B2B platforms?
It feels like a no-brainer and the next big thing. That's twice I've said that. But anything around business and enabling business, right? And platforms are always the place you see it first. What is it famously that more than 65, 70% of Shopify's revenue comes from financial services? And that is true for any other platform, but not everybody's Shopify. They, of course, use Stripe Capital. When I first spoke to Luke, the new CEO of Pipe.com, he described what he was building as Stripe Capital for everybody else. And indeed, that's what OatFi sounds a little bit like, although targeted quite specifically at a niche here of platforms and whatever you're doing. Because we saw CapChase and several others do things like BNPL for B2B, sort of that, it's a 12-month contract, but you can get the revenue up front. Or you saw the revenue-based finance, you've got money coming in, we'll finance that for you. It's not invoice financing, it's revenue-based financing because we're using the payments data. I mean, it looks like, to somebody who's unfamiliar, that's just factoring. Well, yes, but with different data. And whenever you're using different data, that's when you're doing underwriting differently. And if you're doing underwriting differently, I think you can make an argument that says this is therefore a different product. At least it's a very similar product, but it's underwritten differently. And I think that's the insight here, is using the data they already have from the flow of funds from payments to underwrite in a different way, packaging that, and then selling it as, hey, would you like some more revenue for the stuff you're already doing? Pretty good sales pitch. Whenever somebody says it's risk-free, I immediately go, no, it's not. There's a little voice inside my head that spent a long time in financial services and just goes alarm.
There's no such thing as risk-free. Right.
Yeah, like, which regulator is going to kick me and how hard and when? Like, that's my immediate thought. Now, of course, does it matter, and have I long since moved on and retired by then? That's a different question. That's probably why I have not retired and I'm not very rich. That aside, the risk-free side of it, but I do think with this, if they are the lender of record, we have a lot of established models for what that sort of looks like, right? Like, who's doing the underwriting and the lending doesn't necessarily have to be the brand you're interacting with. Same for payments. What would be interesting is to understand the regulatory implications of this and really play that out for 5 to 10 years. Definitely one for a Nerd Corner future episode to try and unpack. But I like this. I think, was it the QED and BCG report said embedded finance is going to grow from about 70 some odd billion in revenue today to 320 billion by 2030. It's the fastest growing sector in all of fintech by pure revenue growth. And it's expanding away from just being payments into everything else. And this is a really big part of that growth engine. Most of financial services revenue and profit comes from lending. B2B is where you can do stuff in fintech because you don't have the CFPB standing over your shoulder going, put that down, stop it, shush. Then, you can play here. So lots to unpack there.
I completely agree with you. The risk-free thing is a great point. And it's something that I just immediately, when I see risk-free, I'm like, well, there's a trade happening there. Something's happening there because nothing is really truly risk-free. And I think in this particular case, setting aside the compliance questions, which I think are good ones, the other thing I think about with risk-free is, okay, if you're telling me I'm taking zero credit risk, I'm also not getting almost nearly as much of the upside as I otherwise would, right? Like, there's a cost to risk-free. And so if these providers, if an OatFi is saying this is risk-free, what I hear is we're taking a very large percentage of the upside in order to take that risk, which is fair, right? So I think this is why someone like a Shopify is always going to negotiate a different deal and do this differently, is they want as much of that upside as possible and have the leverage to get it. But if you're working with someone like an OatFi or Pipe, or actually Stripe Capital does this for other platforms. Stripe Capital for Platforms is its own sort of infrastructure version of what Stripe does here. There's a few different providers in this space. If they're taking on the risk, they're taking on a lot of the upside as well. The other thing that it makes me think of that I think is kind of curious is they're also going to exercise a lot of control over it, right? So if they're taking the risk, they're going to be the ones deciding, yes, we want to say yes to this one, we want to say no to this one. they're the ones who are going to control the servicing experience. And so if one of your business customers calls up and says, hey, I have this thing that's happening with my business. I'm not going to be able to make a payment on this loan, but I would love to restructure it so that I can skip these two payments and then catch up in a quarter when I have more revenue. You, as the platform provider, might want to do that because you value the entirety of the relationship you have with that business. That doesn't necessarily mean that your lending as a service partner is going to feel exactly the same way because they're the ones who own the risk, not you. And so it does remove a little bit of the control and the nature of having that direct relationship with your business customer. And that's, I guess, the thing, to your point about embedded finance broadly, that's the thing I'll be really curious about is how much do brands in this embedded finance future that we're moving towards, how much do they want to be able to control this stuff? And how much do they want to be able to kind of offload to others? And we saw actually a version of this with Buy Now, Pay Later, where the Buy Now, Pay Later companies were actually able, I can't remember who it was I think it was Alex maybe at Andreessen Horowitz who wrote about this on their fintech team, but he always talked about Buy Now, Pay Later as a negative CAC business because merchants were literally paying you to send customers to you. But the reason they were doing that is the merchants didn't want to have to deal with being the lender of record or being the customer service or, heaven forbid, being the collections agency that reached out to delinquent customers. They didn't want that brand association. So they offloaded it to Affirm and to Klarna and to Afterpay. But the benefit to those companies is it's a more lucrative model for them. They get to take more ownership and they get more control over the customer relationship and all of those things. So as we move into more of an embedded finance future, I'll be very curious to see how all of these companies that are getting into embedded finance think strategically about the value of control, the value of the relationship versus the brand risk of having that part of the relationship and the associated costs and compliance and legal and reputational risks and all the other things that come with adding financial services to your stack.
I also wonder about like the future of a division of a bank that would have been called Trade and Working Capital, which is sophisticated lending solutions for financial institutions, FIG, and NBFIs, non-bank financial institutions, as you would define it in the banking world. You know, and somebody like FinWise or many of the Utah banks or even Wells Fargo, right? They sponsor programs for large fintech companies, but they also work with other types of lenders to build lending programs. I think Intuit uses WebBank or Celtic, I can't remember.
Yeah.
And so you can build a custom program and it's a bit more. But to your point about BNPL made me think, well, actually, there's a brand to be built here at the front. And if I build that brand, I can take some of that opportunity cost, something that was very sort of crafted.
Yep.
Every time you go to a bank, you design a new sort of lending model and a credit model, and they approve it, and da-da-da-da-da. Could you start to productize some of this? And then could you get the data exhaust? And could you build relationships with the platform's customer? In other words, the customer of the platform, the businesses, the e-commerce shop, the gym, the whatever it is. Could you, as OatFi, build that relationship in the way Klarna and Affirm has with consumers? And what does that enable you to do? That's a really interesting thought, and I hadn't seen that. So
it's a good call. I think the other thing on that note, just real quick, and then we'll wrap up on this one, is there's a big difference between, are you the payment provider who's also doing lending as infrastructure, or are you just doing the lending piece? And so this is where you divide up Stripe Capital for platforms. It works as long as the platforms are using Stripe for payments as well, because they have to see their payment data in order to underwrite. Adyen does the same thing. Adyen has a capital for platforms business, but it's contingent on you using their payment processing as the platform in order to do that. That, to me, is one kind of category of providers in the space. The other is the lending infrastructure that's integrated with, but separate from the payment process. Bring your own payment processor. And so that is OatFi, Canmon is another one here, Pipe is another one. They all fit into that category. And to your point about the brand, I would be very curious to see, I mean, obviously Stripe and Adyen, like they have a much larger strategy for how all these different pieces connect to each other. But yeah, like if you're an OatFi, can you insist or make the case to your platform customers that you don't want to white label this, and it doesn't make sense to white label it, and we don't really want you to white label it. Like, call it the OatFi lending platform and give us a direct relationship to those customers. That has certainly worked out well for Klarna and Affirm, but I wonder if the dynamics in B2B are a bit different than they are in B2C in that way. So that's the thing I'll be very curious about. Should we move on to your second company? I can't wait to hear it.
Yeah, so the second company is called Tapi. You mentioned Adyen, you mentioned Stripe.
Yes.
Tapi is the Stripe or Adyen for LATAM countries that, again, are more on the emerging side of fintech. So Argentina, Colombia, Peru, Chile, and Mexico. It supports local payment methods like airtime and cash in and cash out, and a lot of local payment networks. So Tapi, its product would look like sort of the very basics of what you think of from a Stripe, right? They do a checkout, which is like this really clean white label checkout that's somewhat customizable, that's optimized for conversion. They help you with the recurring payments or Stripe billing. They help you manage kind of all of that. But you can do it via cash in and cash out. You can do it via Pix. You can do it via all of these local payment types that are historically not as well accepted by the Stripes and the Adyen of the world. In fact, if you talk to Yevgenis, whose last name I can't escape me, the popular fintech guy, really lovely chap.
Yeah, he's great.
He will tell you that Latin America is not a growth market for Adyen. In fact, there are sort of homegrown payments companies that do very well. I happened to bump into the COO of one of the Colombian banks recently who said, yeah, that QR codes are the number one payment network in Colombia at the moment, more than Visa and MasterCard. And it made me think of how Adyen initially became popular in Europe, which is, of course, again, in Europe, Visa and MasterCard do not dominate in every market. In the Scandinavian region, it's Vips and Swish and so on. In the Netherlands, Ideal is the local payment network, the debit card network. And so what Adyen did is it supported all of these, as well as it supported Visa and MasterCard, and gave you that Stripe-like experience in all of those markets. Now, what you see is Stripe and Adyen are monsters transatlantically who can support a lot of these payment methods, but they're just not growing in Latin America. They're doing quite well in Asia Pacific, but they're having to look to partner. And there's no such thing as a truly global payments company, but there are regional powerhouses. And there is a gap in the market, I think, for a regional powerhouse in these growth LATAM markets that this could be a play to do. So I think Tapi's opportunity is to really bring a type of experience that you would expect from a Stripe or an Adyen to markets where Stripe or Adyen don't necessarily have the infrastructure or the focus to really win. Because as they think about it and where their volume is and where their demand is, they're going to start Brazil, then Mexico, and then work their way back. They're not going to come up from the growth markets necessarily. So I think their timing could be really good.
I think your point about Adyen and sort of how they got started, and even like you think about Stripe in the US, right? Like the whole sort of nature of this is there are opportunities that incumbents ignore because you just can't prioritize it relative to the other things that are going on, right? And it's like I joke about this sometimes with like fintech startups, because they'll be like, hey, I have an idea for a thing I want to do, and I'm like, just so you know, there's no way that someone hasn't already noticed this or had this idea. And the arbitrage opportunity that you have as a startup is if you pick the right area, it's at the bottom of the priority list of an incumbent who knows it's a big deal. And I guarantee you there's someone inside this 5,000 person company who is screaming bloody murder saying this is an opportunity, but the problem is they can't move it. They don't have the juice to move it to the top of the priority list. It's a huge opportunity. It's a growth market. It's going to explode. We have to get there first. It's sitting there waiting for us. We are the best positioned company to be able to do this, and they don't. And it's not really for bad reasons. It's just the nature of big companies is they can't be everywhere all the time doing everything, and they have to prioritize. And particularly Stripe is a little different, I guess, because they're still private and they're still kind of a growth-oriented mindset company. But particularly when you go public, like you have to hit your numbers quarterly, right? Like you don't have the opportunity to go, we're going to place a long-term bet in this market that we can't explain to our investors on quarterly earnings calls for the next 8 quarters, but after that, it might be a really good story to tell. That's just not how larger companies work. So I think recognizing that as an opportunity, and I like this as a mental model actually for thinking about where are the other places where there's clearly a growth market and there are incumbents or sort of a semi-incumbent like a Stripe or an Adyen who could tackle that space, but it's not at the top of their priority list. Like that's a really interesting framing for thinking about it, because if you pick the right area, to your point, I mean, it sounds like, I haven't really dug into Tappy, but it sounds like what they're doing is not unfamiliar to what like a Stripe already knows how to do really well, or an Adyen. Like, it's not like it's some brilliant technical innovation or a product no one has ever seen before. It's literally just, we're going to do this in this place before other people can get there. And that's our opportunity.
Yeah, and who's your ICP and how are you winning with them, right? So if you go back to the beginning of Stripe's life, their ideal customer profile was somebody relatively small. Today, their ideal customer profile is DoorDash or somebody
or
of that
Ford
sort
or
of
something.
scale.
Yeah, right.
Yeah, massive. And that's what moves the needle for them. Or their ideal customer profile is OpenAI. They're still really good at like those on-ramps into that next big growth company. Like they still serve a lot of SME customers, but some of those go on to become enterprise customers. They've kind of got that figured out in the US like nowhere else. But what if those homegrown answers start to appear in other markets? What if there's just a need for a good e-commerce solution that supports these payment methods that's kind of default local and that has some sort of go-to-market? So I think there's space for it. And yeah, like the point about market entry not being at the top of the priority list is somebody will enter a market, but they won't necessarily deliver the features that you need to win in that market. And you can't get those prioritized because it doesn't make any sense to, because the thing that would move the needle is tweaking this other dial over here that wins me the next big enterprise client. Like it's rationally the right thing to do is the wrong thing to do in a lot of ways. The saying that was going through my mind was market entry is cheap when markets are small, but so's the prize. The prize is very, very small.
Right.
So because the prize is small, there's no return on that investment. And there might not be a return in that investment, but entering that market is really, really cheap. The problem is most people try and buy into that market after it's already big. And when a market is big, market entry is expensive. And so this is the kind of the challenge and the trade-off that you see constantly with incumbents trying to buy back in. And one route to do that is acquisition, which, could potentially be interesting to watch these markets evolve and see, would a global brand want to acquire something like this, or would they go on and succeed by themselves?
Yeah, well, and I think the other thing that ties into all of this, I completely agree with that framework, is just, is this an area that if you're buying into it later, either through acquisition or trying to do it yourself, how much does brand matter is the other thing I think about a lot in this stuff, because, to your point, within sort of the startup ecosystem and, payments, Stripe just has a great brand. And it actually might not be the best choice necessarily for payment processing. There's a lot of sort of people who are coming out behind Stripe kind of trying to unbundle different parts of Stripe and kind of saying, hey, they've moved on to enterprise. Like you should use us instead. We're Stripe, 15 years ago or whatever, 10 years ago. But there's a brand value to being Stripe that kind of keeps you durable in those markets, even when you're not the most rationally smart choice. And so to your point, I think the long-term value of getting a foothold in one of these growth markets and the growth market demonstrating more attractive returns over time is that you accrue a lot of the brand value. And even when you have other rational competitors in market that people might want to consider, you're the default yes. And so there is, I think, definitely a benefit to that. That'll be one to watch. I like it. Simon, can I give you my last company?
Please do.
Mine is one actually that was just in the news today. So it's on my brain. Not a startup. So a little later stage, but I don't think you and I have talked about them before. Aven, the credit card backed by your home equity that you have in your house. So they just raised a Series D and just became a unicorn, as a matter of fact. So congratulations to Aven. It's a little funny to me to think about unicorns being minted at Series D rather than Series C, because I remember at the height of all of the madness, it was the $100 million Series C round that would push you into unicorn status a lot of times. And a lot of those unicorns have sort of turned into zombie unicorns now. And so I'm happy for Aven that they took it a little slower and seemingly are getting to this stage now. But the product itself is very interesting. It is essentially, like I just described, a revolving credit card that is underwritten based on the equity that you have in your home. And so the basic principle of the idea is that if you are, let's say, 40 years old and you own a home and you have some equity built up in that home at this point, and you also, while you make a relatively good income, you're sort of one of those, Lending Club always describes them as like high income, high FICO, high debt, right? Like you have a lot of credit card debt. You're not living a very financially healthy life, but you also have a lot of like assets at your disposal to kind of turn that situation around. The Aven product essentially is one where they use the collateral, the equity that you have in your home, as a way to more cheaply reprice people who are spending a lot of money on revolving debt on their credit card. So if you're paying, whatever, 22% on your revolving debt on your credit card and you have a lot of credit card debt, that's just not a logical way to carry that debt. So, hey, get the Aven credit card, balance transfer that over to this card, and you can refinance that debt at a much lower rate. And so the thing that the Aven founding team, I think, constantly hits as a refrain is unsecured revolving debt is crazy and no one should take it out. It's really expensive. If you're going to have revolving debt, if you're going to carry debt, don't do it in an unsecured fashion. Do it in a secured fashion where we can buy down that rate by looking at the collateral that you have via equity in your home. Or I suppose not even, but you see this in other places with, credit cards that are backed by your car title or just other assets you have, right? Like you see this as an emerging category in fintech is lowering the cost of borrowing by tapping into the value of assets that haven't historically been utilized in this way. So I think it's very interesting. I think it's something that is kind of running smack into the competition that revolving unsecured credit products are getting from unsecured closed-end credit products. So in the same way that like this is attacking people who revolve credit card debt who should be doing it in a smarter way, that group is also somewhat being attacked by BNPL, who's saying revolving debt is a stupid structure. You should use closed-end debt instead if you need to finance something. So I guess this is just another avenue that credit cards, particularly for a revolving audience, are sort of being attacked on. What's your feeling on this?
First of all, can I just emphasize how important that point is? Credit cards are such a giant profit pool that make money off people being stupid. And I don't mean that to be mean to people, but it's
just literally an irrational way to use the product.
Behavior. Yeah. Mm-hmm. Like the best way for that product to succeed is if you do things that are not in your rational interest. And that is just, I'm sorry, but the BNPL providers are right. Like if there's a bad guy on the landscape, it's subprime credit cards. Like they're of the mainstream financial products that we allow that we don't classify as usury.
Yep.
They're at the like naughty end of like,
totally.
You can use them rationally to build credit. Yes. But most people don't. And that's how they make their money, is because most people don't. That's the quiet part out loud. So of course it's being attacked. And there are many ways to attack it. There are ways to attack it for, I just need that thing. And it would be really nice to spread the cash out over this fixed thing because I feel like I understand it. And then there's the, oh, wait, I've got a mortgage. I'm a few years in. We booked a holiday on the 0% card and the introductory rate went away and now it's revolving and now I don't really have time to do it. That person could actually sustainably live off of this thing that could come also with rewards that is also maximizing it. Like families that have a good P&L but don't necessarily have the right products in that P&L from a financing standpoint are very, very different to sort of the optimized P&L that you would see in a business or something like that. So I like this. As you were talking about it, like good that they made a unicorn. Sounds like their business is growing. It feels like business is probably doing pretty well, especially in a higher rate environment where like the revolving rates have been trickling up. And that's key for a lot of banks who are having to pay more. Their cost of funds has gone up because they're having to start rewarding savers and depositors. But also they're seeing that like, well, okay, base rate is up. So now I need to increase this rate. I can do it. I can profit from it. But there's space, there's opportunity, and people are feeling that pinch. People, especially goodness, in the UK, it's common for us to not have a single rate mortgage for the entire time, or somebody who's just bought a new house or had to move. They didn't get the 30-year mortgage fixed at that ultra low rate. They're in cost trouble now if you have to move across the country for a job or whatever. So people are feeling it, and it may not be obvious, but I think you see it in the general level of frustrations in society that people aren't feeling well off, even though the economy's doing really well. And products like this can be a real solution. So their timing is really, really good. I just wonder how long it is until every neobank has this product, and why there isn't really a mass affluent consumer neobank necessarily in the US. Because Monzo is kind of that, right? Like,
Yeah.
if you're early 40s in the UK, it's stalling on Monzo is your default, your daily driver, right? Like, they're top of wallet for you. They actually charge fees. Like, it's not as good a deal as somebody like a Chime, and like, it has that premium feel to it that somebody that has the Amex Platinum also has Monzo. Like, that's kind of where it's Chase Sapphire and Monzo. They would live well together in the UK.
Yeah.
That doesn't really exist in the US, whereas this sort of plays in that space, or at least could. And that's interesting to me.
Yeah, no, I think that's right. I mean, when I think about how this fits into the US landscape, it's really competitive with like SoFi and Lending Club is kind of how I think about it, right? Because both of those guys, obviously they were fintech companies. Now they're banks. They bought banks. They both started with higher income, more affluent customers, but there were also high debt. But the difference, to your point, Simon, and I think it's a really interesting observation, is both SoFi and Lending Club's model was pay off your debt, pay down your debt, get out of revolving debt, right? And so like, you take out this loan from us, pay down your student loans or refinance your student loans, or in the case of Lending Club, refinance your credit card debt. And then I think the hope, not that this always manifested, is, you will have removed that debt obligation from you. We're refinancing it, and now you're not in credit card debt. Now we've moved you onto a different path. The challenge, I think, if you look at like a SoFi or a Lending Club, is they're still in the process of kind of building out the rest of that neobank, right? Like, they're still in the process, and I shouldn't say neobank, just bank, but like, they're in the process of trying to figure out, what does it mean to be a SoFi banking customer? What does it mean to be a SoFi credit card customer? What are all the other parts of that once we've gotten that refinance part out of the way? And I think it's hard because someone who goes to SoFi to refinance their student loan or goes to Lending Club to refinance their credit card debt, they're probably thinking of that as a one-time interaction, not a ongoing transactional relationship. And so making that jump from, you're helping me do this one thing, to you're going to be a banking provider that I work with over the long term, that's a big like mental jump to go from one to the other. Even by virtue of building this as a revolving card that just refinances your rate at a lower rate because they're using the equity in your home. The nice thing is you're now in a transactional relationship with Aven. They become the card that you use. You get 2% cash back on everything you're doing. And so you immediately jump into that top of wallet transactional relationship you have with customers. So strangely, I think Aven has maybe gotten a little further on becoming that top of wallet recurring banking provider than like a SoFi or a Lending Club have, even though they've been at it for a much longer time. So that's really interesting. The flip side, though, and I'd love your take on this real quick, is Aven is not helping you get out of debt. They're reducing the amount that you're paying. But if I'm carrying a large amount that I am revolving on a credit card, now I'm revolving that at a lower rate. I'm saving money, but I'm not necessarily moving out of debt in the same way that a closed-end loan that helps me refinance and then pay off my credit card debt theoretically can do. So for Aven, I guess the question I would have is, what is their plan for building out the sort of larger financial health stack around this product? How do they want people using it? Do they want people to revolve long-term? Do they want people to turn into high net worth transactors that don't revolve as much? I saw that they offer a kind of a closed-end BNPL-ish type product that's kind of attached to the card. So maybe that's a way to kind of work that. But once you have these customer relationships, how do you nurture them long-term and make sure that you're not just keeping people in debt, but helping them move in a more financially healthy direction?
Yeah, and do they want to? I think that's a really good question. It's like on the spectrum of lending evilness, this is a little bit better than the revolving credit card, but not all the way better to the point where I'm trying to get you out of it.
And by the way, I should say, Lending Club and the other ones who refinance credit card debt, guess what someone does when they refinance their credit card debt? They go fill it back up with more debt on their credit card. So it's not like those guys are like necessarily getting people to completely change their lives, because consumers don't always want to change, to your point.
Well, exactly. Financial products don't solve behavior problems. And I think that the question is, what financial product should you sell somebody? And if this is filling up their credit line, then maybe they should be doing it at lower cost. And maybe that's a net positive for anybody involved. And yeah, the silver lining here is at least you're not paying as much as you were, and you're using something you've already got. And if you're going to behave that way, well, you really shouldn't, but okay, let's try and make it a little bit better for you. That's a good place to be. I like it. I think it's a really positive product. Let's see if they announce any numbers or metrics. I need to look into it, and I need to write it up to have more fully formed thoughts on their trajectory from here. But I can't understand why everybody is not trying to copy and paste this into their neobank and banking app. And I imagine the infrastructure company that packages this and productizes it is already out selling it at the moment, of which I know there are several credit card issuer processors that do things along these lines, for instance, and servicing companies. So I'm sure we'll see this popping up elsewhere.
Yeah, any good idea immediately gets repackaged as infrastructure. So I think you're absolutely right about that. Could be Aven, who spins off a little infrastructure division as well. So, Simon, before I let you go, can we manifest a couple of fintech ideas that we want to see in the ecosystem? Can I go first?
Yeah, please do.
Okay. So I have a quick one for you before I let you go, which is we've talked a few times about better technology and better infrastructure for regulators. And I think we've talked about it with data sharing. I think we've talked about a bunch of stuff. But I have a specific angle on this that I've heard. I'm in Washington, D.C. this week, so I've been talking to a lot of folks on the regulatory side. So one of the challenges in banking as a service, our favorite topic, and one that just we can't escape no matter how good we are, Simon, it seems like we're not allowed to not talk about banking as a service. But one of the challenges in banking as a service is that if you are a fintech partner that is working with a bank, and the bank gets examined by their regulator, and the regulator flags X, Y, and Z concerns. Hey, you have a BSA issue here. You're doing this thing wrong with, your KYC process. You need to adjust this. One of the challenges is that banks are really restricted in what they can tell people outside the bank about what their regulators told them, because a lot of stuff is subject to confidentiality, right? And the rationale behind that originally was, whenever these statutes were written, we don't want to cause a bank run by publicizing the problems with banks. This is why the list of troubled banks that have bad CAMEL scores, you can't find it anywhere publicly, because regulators don't want to undermine safety and soundness by making it publicly available. However, that goal, which I agree with and I think is very laudable, runs into the challenge of, if you have a service provider or a partner like a fintech company, or I suppose a BaaS middleware platform that you're working with, yes, technically they're not part of the bank, but they are part of your distribution infrastructure for reaching end customers. And in a lot of cases, they're the ones actually controlling those front-end processes and providing input into how AML should work and KYC and some of the things they're doing. You need some kind of mechanism to securely share insights about what regulators are telling you to those partners, but in a way that compartmentalizes the information, controls access to it, whatever, can be as secure as possible. I wonder if there's infrastructure that could be built that would allow for regulatory information or insights to be more securely shared in a way that makes them feel better about confidentiality, but gets the information to the people that they need to have see it. That's my idea.
Yeah, show not tell with a lot of this stuff. I love the work of AIR and tech sprints, and once you show the regulator that this is entirely possible, I mean, a lot of the BaaS providers are now trying to do it. I know Sardine does it. I think some of Sardine's competitors do it. They have that ability to enforce policy further down and then confidentially share information on SARs and UARs and all of that sort of stuff. So let's manifest that to happen. And let's manifest what I was going to go for is that sort of confidential data sharing open source standard. Like, let's make that an open source thing that's kind of a default. I know we've talked about that a little bit in the past, but I want to manifest that just being like something that's done regularly. Why isn't it possible to not just build on your idea to share information, but to share that information in a way that is consistent and confidential? So yeah, that number one. And number two, I think there's a real opportunity to use Gen AI to translate some of those regulations to a given context. That's a very challenging thing to do. But if we could sort of understand whether the letter of the law is being challenged and the letter of policy is being challenged, and we could build exceptions to that. That was always the get out of jail free card in a bank, was the exception to policy, the ETP. And if we can get an exception for something along these lines in banking as a service, that could be a good model to try and replicate.
I like that. I think that's a very, very interesting model. Yeah, I mean, how we can apply technology to sort of solve some of those things and just go, hey, like, what if we just extended this thing over here? I like that. I think that's good.
Let's do it, my friend. Let's extend that thing that works over there and move it over here. That's the way future.
Okay, well, that's perfect. I think that's a good note to end on.
All right. It's always a pleasure, sir. You look after yourself, and let's do more not fintech advice in the near future.
Appreciate it.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.